Hello, I'm Ron Wilson. In this month's news, Australia's December quarter GDP figures surprised many by recording higher than expected annual economic growth of 3% per annum for 2015. Consumer spending was a major contributor, while the tourism, education and retail sectors have benefited from a drop in the dollar. Turning to the Australian housing market, local economists and industry pundits have downplayed international concerns over the risk of a housing market bubble. In international news, US consumer confidence fell to a 7-month low in February, and the People's Bank of China reduced the reserve requirement ratio for banks amid concerns of a liquidity squeeze. Michael Pollock has the details.
Australia's GDP grew at a strong 3% throughout 2015 as non-mining activity and export volumes helped offset the slump in mining investment. The 0.6% GDP growth in the December quarter was higher than market forecasts. Consumer spending was one of the big contributors to growth, adding 0.5% to December quarter growth and increasing 2.9% for the year. Sectors such as tourism, education and retail, which struggled when the Australian dollar was around parity with the US dollar, also contributed to a more positive economic environment as the Australian dollar declined. The ABS reported annual wage growth of only 2.2% per annum for the 2015 calendar year. This was the lowest annual wage growth recorded by the ABS since 1998. On a seasonally adjusted basis, the ABS wage price index only rose by 0.5% in the December quarter. Financial and insurance services recorded the largest quarterly rise of all industries at 1.1%, while the smallest quarterly increase was in mining at only 0.1%. Public sector wage growth of 0.6% for the quarter slightly outpaced the private sector at 0.5%, leaving private sector wages up just 2% over the year. US consumer confidence fell in February to a 7-month low as consumers held growing concerns over business conditions and their personal financial situations. The Conference Board Consumer Confidence Index, which rose moderately in January, fell from 97.8 to 92.2 in February. Both the Present Situation Index and Expectations Index decreased respectively from 116.6 to 112.1 and from 85.3 to 78.9 in February. There was reduced optimism for the labour market, with expectations of more jobs in the months ahead decreasing from 13.4% to 12.2%. while expectations of fewer jobs increased slightly to 17.2%. China's central bank, the People's Bank of China, or PBOC, lowered the amount of deposits banks must hold as reserves by 0.5% to 17%, effective from March 1. This reduction in the reserve requirement ratio represented a significant change in the central bank's stance from the previous 2 months, when it had resisted similar action for fears of accentuating downward pressure upon the yuan. In foreign exchange markets, the PBOC had been selling dollars and buying yuan to support the value of its currency, which had the effect of withdrawing liquidity from the market. The about face reflected the fact that a severe liquidity squeeze was becoming the number one threat to the country's overall financial stability. The 9th biannual Household Financial Comfort Report, released by ME Bank, found that Australians were feeling more comfortable with their financial affairs in the 6 months to December 2015. The report tracks Australian households' overall comfort with their financial situation and the potential differences between household types. Respondents to a biannual survey on which the report is based rated their household financial comfort expectations and confidence on a scale from 0 to 10 across 11 different measures, some of which include ability to cope with financial emergency, household income, living expenses, overall debt, and overall net wealth. The combined scores across all households comprise the Household Financial Comfort Index, which rose 3% to 5.59 out of 10 for the 6 months to December 2015. This is equivalent to approximately 65% of Australian households reporting mid to high financial comfort. In contrast to recently publicised opinions from some US economists and concerns raised by the IMF and the Bank of International Settlements, Australian economists have generally downplayed the hype around the potential for a local housing market crash. UBS Asset Management's Head of Investment Strategy, Tracy McNaughton, believed that the hype around a housing bubble in Australia is overdone, with investors not as stretched and banks not as stressed as the headlines might suggest. AMP Capital's head of investment strategy and chief economist Shane Oliver also questioned the validity of calls of a 50% fall in house prices in Sydney and Melbourne. While he considered that house prices are likely to experience a further 5 to 10% cyclical fall within the next few years, he also noted that Australian property is no more overvalued than it was a decade or so ago. Oliver, like McNaughton, drew attention to the ratio of household debt to income and noted it is about the same as it was prior to the GFC. However, interest costs are much lower, and there are no signs that Australians are having trouble servicing their debts. As expected, the RBA maintained the cash rate at 2% at its March meeting, despite some concerns in the market over the higher than expected level of the Australian dollar. Following the announcement, the currency remained well above the mid-January low of 68.5 US cents. The RBA's outlook for domestic inflation was for it to remain low over the next year or two, with growth in labour costs continuing to be quite subdued and inflation restrained overseas.